Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Tariff reprieve. Global tech stocks and futures rise as President Trump exempts phones, computers and consumer electronics from his headline tariffs on China. But he warns the reprieve is only temporary. China's exports surge ahead of US tariffs, with near-record shipments flowing to Southeast Asia in March. President Xi begins his first overseas trip this year to the region. Plus, Europe's luxury sector is set to face questions on the potential fallout from US tariffs, with LVMH and Moncler reporting earnings this week. We'll bring you the preview. A very good morning. Happy Monday. Welcome to a new week. I could forgive you if you're still recovering from the last one, though. What a roller coaster ride it was in markets, though in the end it was the best week for the S&P 500 since November 2023. And this morning you've got futures pointing higher on both sides of the Atlantic, given we have had the news from Donald Trump over the weekend that he is going to give a reprieve for consumer electronics. But he says that's just a procedural step and there is more to come. So the uncertainty continues. Let's flip over to the cross-asset picture now. And a question of last week, a big question, was whether treasuries are actually acting as a risk asset themselves. You've currently got the 10-year yield at 4.46%. We'll keep an eye on that. But euro-dollar at a 113 handle. Is this the new safe haven asset? And how high can the euro go before it starts becoming a problem for European equities? One to bear in mind for today's session. But we've also got oil here at $64 a barrel on Brent, weaker 0.25%. Lots to consider today if you are an oil trader, not just the tariff story, but also these US-Iran nuclear talks over the weekend, continuing next weekend, and the IEA and OPEC reports that we'll get over the next couple of days. And then just finally, let's look at gold here, hitting a new record, though down 0.33% currently. But this really underscoring what uncertainty there is in markets. The traditional safe haven at the bottom there. Let's get over now to Avril Hong. She's on standby for us in Singapore with a look at how Asian markets are faring with all of this tariff news. Avril.
Yeah, Lizzie, the fact that they're getting an exemption on the tariff front, but only temporary for this consumer electronics. So we're seeing tech stocks reacting and they're paring gains from earlier, including the chip-related names. We are also seeing the likes of the Nikkei, the TAIEX enjoying a bit of a balance today. But keep in mind that they're still down about 14-15% for the year. And we are keeping a close watch on dollar yen as well. We saw a bit of a pop higher following BOJ Governor Ueda's comments earlier today that seemed to be directed towards erasing expectations there. We're going to see a policy hike in the next couple of weeks, but keep in mind it's really about the dollar slump. So we're actually not far from the lows of last week on dollar yen of 142, and beyond that, maybe we see it taking out 140. Now flip the board and take a look at Chinese stocks, which are also bouncing higher today. And this is against the backdrop of exports data, which showed a surge of 12+% versus estimates of 4+%. So a boost to the economy, but it's all already being attributed to front loading. We also had the likes of Goldman for the second time this month cutting their China stock targets. Flip the board and take a look at this chart as well, just giving you a bit of color as we see China stocks rising today. From the bottom last week, we've actually been seeing them leading the global rebound. So the Hang Seng China, meaning the China stocks in Hong Kong, they've actually climbed about 10%. But of course, a couple of caveats here, including from the likes of David Inglis, who supplied this chart, in that when you look at this, we, of course, don't know for sure whether the bottom is in fact already in. It's also quite a tactically skewed chart, but some color for you as we see Chinese stocks rebounding today.
Lovely. Avril Hong, we thank you. Avril Hong out of Singapore. And let's dive into that tariff news now. President Trump has pledged that different US tariffs will be imposed on phones, computers and popular consumer electronics. And that's despite a temporary exemption that was announced on Friday.
The tariffs will be in place in the not distant future, because as you know, like we did with steel, like we did with automobiles, like we did with aluminum, which are now fully on, we'll be doing that with semiconductors, with chips, and numerous other things. And that'll take place in the very near future.
And what rate the semiconductor tariff?
I'm going to be announcing it over the next week.
Let's try and make sense of all of this with Bloomberg's Bill Pare. Bill, I am confused here. It looks like those with the biggest surpluses are getting the biggest reprieves for now, but the allies, like the UK, are in the same position that they were in after Tariff Day. How does that figure?
Yeah, I think Trump has tried to push back on any sense that he's reversing course or stepping away from a strategy of imposing tariffs across the board and some very high tariffs on countries that he thinks have been treating the U.S. unfairly. China has been at the top of that list, but he's also showing, in some cases, the most flexibility, pulling back pretty quickly on those electronic imports that many people associate with Chinese sales to the U.S. So when you're talking about 145% tariffs, a lot of people were wondering, what is that going to mean for my next iPhone or Samsung phone that I buy? What does that mean for a lot of other electronics? For now, Trump's saying that the 145% doesn't apply to those, that they're going to get their own special tariff, and they're talking about giving details of what that rate would be later this week with a publication in the Federal Register. But it does leave a lot of countries still in the same position they were as of, I think, Wednesday last week when he reversed course on the reciprocal tariffs, facing 10% generally as a baseline measure for all sales to the U.S.
And how do we understand how these changes are going to work? He said that nobody's getting off the hook. It's just about moving these electronic items into another bucket. What are we expecting from that next announcement? Is it really just a case of Trump wanting the uncertainty to be the point, to show his power around the world here?
That may be some of it. I mean, I think we've also seen with his reversal on reciprocal tariffs, or that pause for 90 days last week, that there is a pain point for this president, as much as he may not like to admit it. The bond market's moves last week in particular, following those stock market swings, were very concerning. It's something Trump cited himself when he announced his 90-day pause. So I think when you talked about the 145% tariff on China, and you saw companies trying to quickly ship some goods into the U.S., and you've seen Apple trying to reorient some of its supply chains, I think I'm sure there's been a lot of phone calls behind the scenes saying this is all moving a little too quickly. What we're expecting this week is, according to Howard Lutnick, is an announcement in the Federal Register about what that extra bucket of semiconductor or electronics tariffs would be. We would expect it to be much lower than the 145%, but we'll have to see when that comes out. And from there, Howard Lutnick said it could be a couple months before they come into effect.
OK, so the uncertainty continues. Bloomberg's Bill Pare, we thank you. I want to think about now how China is reacting to all of this. President Xi Jinping is on his first overseas trip of the year. It was meant to showcase China's clout in the region, but now President Donald Trump's tariff threats have turned it into more of a push to keep Southeast Asian leaders from cutting deals at Beijing's expense. I'm joined now by Bloomberg's Balash Pens out of Hong Kong. Balash, good to have you with me. What is Xi's message on this tour?
Yes, it's very interesting because all of a sudden these are very tricky negotiations. China has a huge stake in Southeast Asia. Just today, China reported a record exports toward Vietnam. But now they have to keep these countries from cutting deals with the U.S. that would be unfavorable to China. So he has to put out a message to all these countries that he's going to be visiting this week that they can rely on China, that China is a dependable market on the world economy. And all he has to do basically is just point at the U.S. and look at how quickly the conditions with U.S. trade are changing. So his job is going to be to convince them that China is a partner they can and they should rely on in the future.
Okay, Balash Pensby, thank you. Now, let's think about how the markets are reacting to all of this. Minneapolis Fed President Neil Kashkari signaled confidence that they're going to remain orderly as investors sort through President Trump's shifting trade policies. Kashkari was speaking to Face the Nation on CBS.
As a result of all of these renegotiations and these new trade flows and fiscal policy, that new normal is completely out of the central bank's control. We cannot affect that. All we can do is keep inflation expectations anchored and try to manage some of the ups and downs on that journey. But that destination is up to the executive branch and Congress, not the Fed.
So Kashkari trying to inject a bit of calm, but Bloomberg's Valerie Teitel is here with more. And Val, it looks like that volatility is set to continue.
Lizzie, I think one of the most important things from the overnight session is we're finding some relief to the Treasury route. We are lower in yield, seeing a 2 basis point rally in the 10-year yield, and that's after suffering some pretty catastrophic losses of last week. The 10-year yield rose for five straight sessions last week, Lizzie, rising by 60 basis points. So it's nice to see some green on the screen when it comes to the Treasury market. There are a few trades, though, that are extending last week's move. One of those is dollar weakness. We hit a new 6-month low for the Bloomberg Dollar Index and is now trading at fresh lows for the year. So keep an eye on this dollar weakness. This move is extending. On the flip side, Lizzie, the other move that's extending is gold. Gold hit a new record high overnight, and it's now attracting attention from other Wall Street analysts. We had a note out from Goldman last week, again raising their price target for gold, calling for 4,000 price target by in nearly in a year's time by mid 2026. I thought it was interesting, Lizzie, that on a 5-year look back, gold and the S&P 500 are both neck and neck, up around 90%.
Okay, interesting one. Bloomberg's Valerie Teitel, we thank you for pointing that out. Now, coming up on the programme, the EU races to clinch trade deals with countries around the world. There's links with the US sour. We'll look at where the bloc is focusing its efforts next. This is Bloomberg. Let's get to one of our top interviews now. President Trump promised his Swiss counterpart that he would re-examine levies on the nation just hours before suspending much of his tariff onslaught on the world. Karin Keller-Sutter, head of state and finance minister of Switzerland, spoke about that phone call in an interview with Bloomberg's Oliver Crook.
I would say we had a very good conversation, very open and constructive. And, well, I had a chance and I was grateful to be able to explain Switzerland's situation because Switzerland is a very important direct investor in the US. I mean, overall, it's number 6. And when it comes down to manufacture, it's number 4 and R&D, even number 1. So I could explain that to the US president, which was very helpful. And we also talked, of course, about the tariffs and that, of course, we are unhappy about 31%, which is huge. And so we would like to talk about how, in fact, we can come back to a normal basis of tariffs together. And we both agreed that we have to find a solution. So, as I said, it was very constructive. We both agreed to really find a solution, and he promised to look at the situation and then we would have a dialogue again.
And when you make those points about how invested Switzerland is in the United States, is that something that seems to cut through to him? Is that something that he seems to acknowledge? Because he's been very focused on one dimension, which is the sort of trade disparity that exists.
Well, I must say that there was a lot of understanding from the US side for the Swiss situation. And, Swiss companies invest a lot and are planning to invest a lot, but they need a signal. I mean, they have to know how secure this investment will be in the next years. So it is important to have a signal from the US administration that the US is still open for business, also for Switzerland. And I had the feeling that there is a mutual interest for both sides to find a constructive solution.
And he also, obviously, he's talked about pharmaceutical tariffs potentially in the future. This is something that obviously Switzerland and many others are very vulnerable to. Do you have a clear idea of sort of what he's looking for, and do you think you made progress in the direction of that?
Well, I don't. I just read in the press, of course, that there was also a plan to have tariffs on pharmaceutical products. But for the time being, I must say, we have a break, we have a pause, and I think we should benefit from that break to really find solutions on an international basis, because we are all interested in a stable international trade, stable international order, and we don't want to go into recession. And so Switzerland will also, of course, seize this opportunity of this pause of 90 days to find a solution that it is in the interest of both sides.
Swiss President and Finance Minister Karin Keller-Sutter there, speaking exclusively to Bloomberg's Oliver Crook on Friday. Fascinating to get a peek behind the curtain of those trade negotiations. And indeed, the negotiations continue. The European Union racing to clinch trade deals with countries around the world in an effort to diversify away from an increasingly protectionist US. Let's get more now with Ollie Crook. Ollie, the EU's chief trade negotiator Maroš Šefčovič is going to be in Washington today. Where are they going to be focusing their efforts?
Yeah, so you heard there from the Swiss president, something you've heard basically from every European leader and policymaker, which is that we want to regain a normal trading relationship with the United States. That is proving obviously fairly difficult to do, particularly because the Europeans do not have a very clear idea of specifically what the Trump administration wants from the Europeans, other than basically closing that trade gap. So as you say, Maroš Šefčovič will be in Washington, D.C. today. He will be talking to his counterparts to really try to flesh out the picture for specifically what these U.S. officials want from the Europeans. You will also have Giorgia Meloni, the Italian prime minister, a fairly close Trump ally, as far as, Trump can be said to have allies in the European political spectrum, will be in D.C. also later in the week to try to get some of these ideas from him. And again, this is difficult for the Europeans because the Americans, in a certain sense, have put the gun on the negotiating table, but they have not expressed fully what it is that they want from the Europeans. So it's hard for the Europeans to retort with basically these sort of phenomenal deals. We heard from Jürgen Kukis, the German finance minister. I spoke to him on Friday. He was really touting this zero-for-zero tariff situation where basically tariffs would come down on the European Union, hopefully down in the United States. That does not seem to be enough for the United States right now. What is for certain, Lizzie, is that no matter what happens with this trade discussion with the United States, what you are seeing from European policymakers is a reordering of global trade, rushing to sign trade deals with other parts of the world. You have that Mercosur Latin America deal that was sort of agreed to tentatively at the end of last year, not yet come into force. That gets more urgency. We have the EU talking to the UAE, for example, trying to get a free trade agreement there. These are potentially not things that the United States would like to have as a consequence of the tariff war that they're waging. Though that being said, Lizzie, every trade minister and finance minister that I spoke to last week, when I asked them whether basically the United States is pushing Europe closer to China, they were very reticent to get on board with that sort of concept, saying that really the Chinese conversation is a lot more complicated than that.
So Trump inadvertently lighting a fire under all of these trade talks around the world. Interesting. Trump has also, though, of course, backed off the steepest tariff rises for now. If it's an uncertain outlook for policymakers, surely it is the same for European businesses. How are they preparing for what lies ahead, Ollie?
It's got to be an impossible situation for businesses, Lizzie. I mean, imagine what earnings season is going to look like this quarter. How on earth do you outlook 2025 if you are basically almost any business, but certainly a car maker or, a pharmaceutical company? So we've been been evaluating how these different companies have been dealing with the issues of the trade barriers in the United States. You have Audi, for its part, it suspended all of its imports into the United States. So Grape, which is Portugal's biggest winemaker, basically built up a 6-month stockpile in the United States, which they are currently drawing down on, trying to basically hoping that those trade barriers will come down a little bit to try to sort of preserve their margins. Novartis, for its part, a Swiss company, we're just hearing from the Swiss president there, plans to spend $230 billion over the next 5 years in sort of building out its U.S. operations. That is exactly the kind of thing that the Trump administration would like to see. When you look at the car makers, you also see some different sort of approaches that you've seen. You've seen Volkswagen, for example, talking to dealers, saying that basically these costs, we're going to defer them to you. We're going to put them as fees. That is going to go to the consumer. You have Mercedes that's been rushing to get some of its higher end cars onto the continent before the tariffs kick in. Volvo is going to boost production at its South Carolina plant. Stellantis, for its part, is going to give employee discounts to consumers. So again, these are all the different ways that these businesses are going to try to handle the tariff situation. But as we say, Lizzie, this is going to be a very interesting earnings season.
OK, and we'll be diving into some of the earnings previews later in the programme. Bloomberg's Oliver Crook, we thank you. Now, staying in Europe, Ukraine says that 34 people were killed and 117 injured after Russian missiles struck the city of Sumy on Sunday morning. The city's regional administration says that 2 ballistic missiles, including one equipped with cluster munitions, were fired from Russia. The attack came after US envoy Steve Witkoff met with the Russian President Vladimir Putin to discuss ending the war. Negotiations on a ceasefire have stalled following talks in Saudi Arabia last month. Well, coming up on the programme, global investment in clean steel registered its steepest annual decline in 6 years in 2024. We're going to discuss the outlook next. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe. Now, steel is an essential industrial material from construction to making cars, as the UK has well realised over the weekend after the state rescue of British Steel. Financing had been rising, but last year global investment in clean steel, tracked by Bloomberg NEF, fell to the steepest annual decline in 6 years. Here to tell us more is Yuchen Tang, green steel analyst from BNEF's Sustainable Materials team. Thanks for joining us, Yuchen. This looks like a sharp reversal in investment from continuous growth that we saw since 2018. What happened in 2024?
Yes, indeed. Thanks for having me. So indeed, clean steel investment actually fell by more than half, down from a peak of $40 billion in 2023. And this drop actually spanned across all major project type that we track at BNEF. So these includes the more mature technologies such as the electric arc furnaces or EAFs that recycle scrap steel and can run on renewable power, as well as an emerging type of furnace that can either immediately use or later switch to use clean hydrogen to make iron steel.
And so is this pullback temporary, or could the investment pick up again in the future?
Actually, there are many reasons behind this decline. So let's start with the electric arc furnaces, or the EAFs, which actually accounted for 2/3 of the investment in 2024. So the main reason is that the main market for new EAF investments is China, and its activity actually dried up last year. Because there are many reasons for it. One is the weak demand of steel from the property sector, which is the largest steel using sector in the country. So that has been weak. And another main reason is that the Chinese government decided to suspend a policy, the only policy actually, to allow for any new build steel plants in the country. So that was in a halt since last year to limit overcapacity. So we've also observed a slowdown in the hydrogen-fired clean steel furnaces as well. So as you can see from the chart just now, that there has been a lot of companies announcing clean steel projects in the past, but actually some of these major green steel pioneers like ArcelorMittal decided to delay their project investments because they believe that the hydrogen price is a huge bottleneck, and they believe that the hydrogen cost, the price needs to get below €2 per kilograms.
Yuchen Tang, we'll have to leave it there. Well, thank you, Bloomberg NEF green steel analyst Yuchen Tang. Coming up, bank earnings. Bloomberg. A very good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda. Tariff reprieve. Global tech stocks and futures rise as President Trump exempts phones, computers and consumer electronics from his headline tariffs on China. But he warns the reprieve is only temporary. China's exports surge ahead of US tariffs, with near record shipments flowing to Southeast Asia in March. President Xi begins his first overseas trip to the region this year. Plus, Europe's luxury sector is set to face questions on the potential fallout from US tariffs, with LVMH and Moncler reporting earnings this week. We'll bring you the preview. Well, welcome to the programme. Happy Monday if you're just joining us. And it's looking pretty positive on the equities front on both sides of the Atlantic this morning. This after Donald Trump said over the weekend that there would be a reprieve, however you want to put it, on tariffs on consumer electronics, though he has since said that that's just a procedural step towards applying different specific levies to the sector. But traders appear to be embracing the optimism for now. If we flip over to the cross-asset picture, you can see a big question that we've been asking ourselves over the past week is whether treasuries are becoming a risk asset as Trump tests the patience of bond markets. But actually, currently, you're looking at the 10-year yield down 3 basis points at 4.46%. Meanwhile, euro dollar up 0.2% at 113 handle. Is this a new haven, you might ask? Last week, it posted its fourth biggest weekly gain since 2011. The dollar, on the meantime, retreating today for the fifth straight session. But you also have to ask how much strength is too much strength when it comes to the euro when you're looking at European equities. Meanwhile, you've got gold there hitting a new record, but down now 0.4%, really underscoring the confusion in these markets, and oil having hit a 4-year low last week, now at $64 a barrel on Brent, as traders eye these tariffs, but also these US-Iran nuclear talks, and of course, coming up over the next couple of days, the IEA reports and the OPEC report as well. But I haven't yet mentioned earnings, and of course that is another thing to factor in this week. Wall Street banks continuing to report their results, and Goldman due later today. JP Morgan, of course, was part of the first wave of lenders reporting on Friday, and speaking on an earnings call, CEO Jamie Dimon warned of market turbulence heading into this earnings season.
You're going to hear 1,000 companies report, and they're going to tell you what their guidance is. My guess is a lot will remove it. They're going to tell you what they think it might do to their customers, their base, their earnings, their costs, their tariffs. It's different for every company, but I assume you'll see that. And anecdotally, a lot of people are not doing things because of this. They're going to wait and see.
So a handy prelude to earnings season there from Jamie Dimon, and Charlie Wells is here with analysis. Charlie, what read are banks giving on the impacts of the trade war in their earnings so far?
I mean, Lizzie, that is what everybody cares about this season, right? You know, no matter that JP Morgan, Morgan Stanley had stellar results on that equities trading front, that was the past. Everyone wants to know what this trade war is going to kind of spill through, not only in banks, but in the companies that they lend through. And the CEOs on these calls have been walking this very fine line where, you know, as you heard in that sound excerpt, they've been admitting that there's some difficulty ahead. They've been talking about uncertainty. And Bloomberg actually counted the number of times that executives mentioned variants of the word uncertainty in these calls in the 3 banks that have reported so far. And they surged so far this year. They really did surge compared to previous quarters. So that is really kind of the order of the day. But there's also the sense of trying to project strength, of Dimon saying, you know, we are in the crosshairs of this trade war, but we can deal with it. We've got the tools that we need to handle what comes next.
And so what are we expecting from Goldman today? We've already heard from JP Morgan. What about Goldman?
Goldman's going to be really interesting. And I think, you know, again, analysts are expecting to see a lot of strength in the past for that equities trading unit, for trading more broadly, as we've seen over the past quarter. But the question here is about deals. And I think that's something that this year has been incredibly difficult for these banks, particularly those that are more exposed to that business line. There was so much optimism going into this year, but you've seen IPOs pulled, you've seen M&A activity on pause, and you even heard on Friday Ted Pick of Morgan Stanley talking about how, you know, deals are on pause, not delete. So again, this sense of trying to show kind of honesty, but also the difficulty of this moment.
Okay, I mean, you could say the same for global business, I suppose, right now. And the other thing that's interesting out of these earnings is, of course, the reading on the US consumer. How do the major banks see that right now?
You know, it was striking, actually. What their comments have actually shown, again, a degree of strength here. And I think you maybe wouldn't have expected that given the talk that we hear about tariff uncertainty, about the potential of inflation. But the CFO of JP Morgan, Jeremy Barnum, actually said, you know what, as long as the labor market holds up, we should see the consumer holding up pretty strong. We should see consumer credit being pretty strong. But you contrast those words with some of the numbers that we've seen. And actually in some of these numbers, we've seen an increase in provisions for loan losses, an increase in provisions for souring credit. And so I think, this is something that these banks are going to have to navigate. Again, right now they're seeing the consumer fine, but it seems like they're positioning for weakness in the future.
Okay. Bloomberg's Charlie Wells, we thank you with analysis and a preview of what's to come when it comes to those US bank earnings. And of course, it isn't just the US banks that are reporting this week. We also have the luxury sector here in Europe. The French luxury maker LVMH reporting first quarter revenue later today. Also due this week, we have data from Hermes and the Swiss watch exporters. Inevitably, questions are going to focus on the potential fallout from US tariffs. And we can get more now from Deborah Aitken from Bloomberg Intelligence. Deborah, thanks for joining me around the table. I've got to ask you, is 2025, a 2025 recovery for luxury dead in the water now, thanks to Donald Trump?
Yes, it is. It's plain and simple. We ended last year with flat sales, supported EPS. The company started out this year looking at around 2 to 4% sales growth. We think that's already flat to minus 5%. The best in class, the biggest heritage will hold up the prices best. But, when we think about it, we have the wealth impact. Q3 and Q4 saw the US really as the positive surprise, so that falls away. University of Michigan March figure shows consumer confidence down 11% just out. We have the issue with the tariff uncertainty, and even though these companies have low cost, big gross margin, it still has an impact on EBIT.
Well, yeah, so when it comes to the tariffs and these big luxury names, how do you gauge who's going to weather it best? Is it who's got the least exposure to the US and China? Is it who's managed to move manufacturing over to the US? Is it who can still up prices and get away with it? What's the biggest factor?
It's really a combination of all three, but there aren't that many of the pure luxury companies with much production in the US, including LVMH. And so the biggest impact are the aspirational names who depend on Asia for some of their entry level, the Tapestry, but also Watches of Switzerland. If we get the tariffs there, thinking about the whole of Switzerland, the way they're produced, that could see an EBIT impact of around 8%. For the biggest luxury makers, I mean, half of Watches of Switzerland, for example, the company who have biggest names, Rolex and Patek, they're the kind of brands which will be able to price, but around 25% at group level won't have so much pricing capability, probably at the mid-range. And then if you think about LVMH, probably about 3% EBIT impact. It's not that high, but it is when you consider 25% pricing last year. Yeah. Even Hermes said 6 to 7% pricing this year to cover costs and inflationary cost of very high level labour. And that probably means that they'd need to go to around 9 to 10%. So it could struggle at the bottom end on the fragrances, on the makeup side, those kind of entry level categories, even for the biggest brands. Yeah. So we'd be calling the sector down a little bit from the startup point of 2 to 4%.
Okay, really interesting. And it was interesting as well that Charlie was talking about deal making in banking kind of being put on pause because of all of the tariff uncertainty. But in your space, we've seen Prada buying Versace. Could we see a bit more of that sort of M&A in luxury?
I think first of all we're seeing share buybacks as well, but in particular for Prada and Versace, that came about and was really up for the grab because we saw the deal between Tapestry and Reprieve fall apart at the end of last year after a prolonged intervention from the US. And so if we think about Capri, it needed help on the balance sheet. Versace didn't quite fit. Probably Jimmy Choo comes up as well. And for Prada, with a couple of brands, and now Miu Miu probably at a peak after such growth levels and normalised growth for Prada, Versace can do something for them. But they have warned that it will take a good couple of years to rekindle the growth, to bring out the aesthetics again and really not reinvent, but to reposition the brand, I guess, and orchestrate the brand again to what it used to be.
Okay, so potentially exciting stuff. Deborah Aitken, Bloomberg Intelligence Senior Analyst, we thank you with a look ahead to those luxury earnings. Now, just breaking across the terminal, we do have a headline on Infineon off the back of this latest Trump tariff news. And this is that Infineon is gaining on TradeGate, up 4.9% versus its close on the Xetra DAX. You can see the share price year to date, but of course this is a bit of relief on Donald Trump's reprieve on tariffs on consumer electronics, and he has since said that it's just a procedural step towards a different specific levy for semiconductors, but it looks like traders are looking through that and taking optimism where they can in general. But here, when we look at Infineon, 4.9% up. So we'll wait for the opening trade to see if that is more widespread across the sector. But coming up, traders brace for a new week of tariff turmoil. We're going to discuss with Swiss Re's chief economist for Europe. So stay with us. This is Bloomberg. Welcome back to Bloomberg Daybreak Europe, and we have got futures pointing higher as we head towards the European market open. They are 2.3% higher on Euro Stoxx 50 futures, 1.9% higher on FTSE 100 futures, and 2.1% higher on DAX futures. The same reflected across the pond. S&P E-minis up 1% and Nasdaq futures up 1.4%. So a lot of optimism now that Trump has given a bit of relief on tariffs. But will it last, and do economists agree? Well, we can speak to one of them, Charlotte Mueller, European chief economist over at Swiss Re. She joins me now for a look ahead to the week. Really good to have you with me, Charlotte. The US stock market has kind of rallied since Trump paused his tariffs, but the pessimism lingers amongst economists. How much of a recession risk are you seeing for the US and for the global economy?
Good morning. So yes, there's maybe a bit of short-term optimism with the 90-day pause, and also the EU has also paused its retaliations. But the key message, I would say, is that uncertainty is still high, and uncertainty is not good for business confidence and also consumer confidence. And that's why we still see downside risks to the global economy. If you look at our forecasts, we would say for the US, it's clearly a stagflation shock, so lower growth and higher inflation. Whereas for the European economies, it's really lower growth and also, I would say, lower inflation.
OK, and I want to come back to what that stagflation means for the Fed. But just specifically, what data are you looking at when you're gauging the health of the economy at the moment? Of course, we've got earnings season at the moment, but such a disparity between the hard and the soft data. What are you focusing on?
Yes, so I would say the hard data is outdated or backward looking at the moment, so I would not look at that. And it's really about the survey data or the sentiment data, so looking at consumer confidence or business confidence. We saw on Friday the University of Michigan sentiment survey, which also did fall down significantly, so that's one indicator. And then also looking, I think this week it's a lot about earnings. But again, I would say the Q1 earnings are going to be very backward looking. So we need to look at the forward guidance that we get in the earnings calls. Are there any conversations about potential investment decisions? Those are the key forward indicators that we need to look at.
Yeah, our previous reporter, Charlie Wells, was telling us, you know, you've got CEOs trying to sound confident in this environment, but it's difficult amid all of that uncertainty. Let me also ask you about the ECB meeting that, of course, we've got coming up in Frankfurt on Thursday. The big expectation is for a quarter-point cut, but how do you expect Madame Lagarde to handle the communications right now? So much pressure when we haven't got a Fed meeting till May, and so much to say, really, given all of the tariff news.
Yeah, exactly. So we definitely expect the quarter-point rate cut, even with the 90-day pause in tariffs. Now, why is that? So we've already seen disinflation progress, but I would say the key thing that has changed also for the ECB since the last meeting is uncertainty is up again, even more. And there, I think key things to watch are a bit on their communication around the inflation risks. So do they still say it's two-sided, or do they flag downside risks to the inflation outlook? But otherwise, I think the ECB is going to be very much on a meeting-by-meeting approach. They're not going to want to pre-commit to a specific policy path with the high uncertainty. But I think if we look back at our own forecast, so we still have 1.75% for year-end for the depot rate for the ECB. So that's unchanged relative to our forecast at the start of the year. But I would say definitely at the moment now, there are risks for even more interest rate cuts from the ECB. Why is that? It's because also I think the disinflationary forces have increased. 4 key reasons for that. I would say number one, less global demand, bringing downward pressure on prices. You have oil prices lower. You have also the FX, so the weaker dollar or stronger euro. And then also potentially oversupply from Chinese goods getting rerouted, which I think speaks for lower inflation also in the Eurozone. But that's very different to in the US.
But Charlotte, what about the EU's fiscal boost? How would that change European growth, and how would it interact with those ECB rate cuts that you see ahead?
So the EU fiscal boost doesn't change our policy forecast. What I would say is the fiscal policy announcements, which are a regime shift, they're going to only really show up in the hard data towards the end of this year or even next year. And there I would say it will add some upside to our medium-term growth projections. However, given that there's a lot of slack in the Eurozone economy, I think it will be a rather limited inflation impact. So I think still the story for Europe, for the Eurozone, is lower inflation, which speaks for more ECB rate cuts.
Okay, interesting. And you mentioned earlier that you see stagflation ahead for the US economy. When it comes to the Fed, how limited is it? How straitjacketed is it when it's trying to carry out its dual mandate?
Yeah, so for the Fed, I think the biggest challenge is really for the Fed, whereas for other central banks outside of the U.S., it's very much more clear, more interest rate cuts. For the Fed, they're going to be juggling between higher inflation and then also lower growth and recession concerns. Our view is that the Fed is going to stay on pause for as long as it can. So we still think the next rate cut to come in the summertime. Why is that? That's because they're going to prioritize those inflation concerns. If we looked at the University of Michigan sentiment survey that came out on Friday, 1 year ahead inflation expectations, they shot up to their highest level since the 1980s. So that's well above what we saw even during COVID. So I think the Fed is going to try to stay on pause for as long as it can, and then later on resume rate cuts, earliest I would say in the summertime. Key indicator to watch there is the labor market. If we see softening in labor markets, that could speak for more Fed rate cuts. Originally, we had 2 rate cuts for this year. I would say risks are skewed to potentially now maybe 4 rate cuts this year, all depending on the labor market data.
Okay. Charlotte Muellers, European Chief Economist at Swiss Re, we thank you for that analysis and a preview of that ECB decision coming on Thursday. Now, to the UK, where the Business Secretary has told Sky News that the government will take a more sceptical approach to future Chinese investment in sensitive sectors after it was forced to rescue the country's last primary steel manufacturer. Jonathan Reynolds spoke at an emergency session of the House of Commons on Saturday.
Since taking office, this government has been negotiating in good faith with British Steel's owners, Xingye. We have worked tirelessly to find a way forward, making a generous offer of support to British Steel that included sensible, common-sense conditions to protect the workforce, to protect taxpayers' money, and create a commercially viable company for the future.
And saying in the UK, estate agents are warning that London house prices will suffer the most from the US president's trade war as a global demand slowdown risks hitting the city's already struggling market. Property website Rightmove says that asking prices in London rose just 0.5% in April, with the capital the only UK region to record fewer buyer inquiries than a year earlier. We've got plenty more coming up on the programme for you, so stay with us. This is Bloomberg.
right now we are at a decision-making point and very close to a recession. And I'm worried about something worse than a recession if this isn't handled well. A recession is 2 negative quarters of GDP, and whether it goes slightly there, we always have those things. We have something that's much more profound. We have a breaking down of the monetary order. We are going to change the monetary order.
So that was the Bridgewater founder, Ray Dalio, speaking to NBC's Meet the Press on the impact of those tariffs on the US economy. But those tariffs, of course, are the backdrop to the ECB rate decision that is coming out of Frankfurt on Thursday this week as well. All eyes on that and really on Christine Lagarde's words about the rate path ahead. At the moment, markets are pricing 3 more cuts this year, and those bets have been ramping up the more the tariff blitz has intensified. Now, you can see that here, but if we flip the board, you can also see that the tariff shock has already tightened financial conditions. It'll be interesting whether Christine Lagarde gives a read on how she sees the trade war impacting the euro area economy. Does she say that this language around policy having become meaningfully less restrictive needs to be dropped? We'll keep an eye on that. But flip the board again and we can see how the euro has been faring amid all of this. Look at this trend line and look at the euro popping up above this bearish trend line. That is significant, but will it have legs? And how much of an impact is that going to have on European equities? When does good become too good when it's in terms of stocks? If you think about the inflation impact, of course, if you've got a stronger currency, it makes imports less expensive and it puts downward pressure on inflation. So a helping hand for the ECB. That's it for Daybreak Europe, but don't miss our exclusive conversation with the US Treasury Secretary Scott Bessent, live in Buenos Aires with Anne-Marie Hordern. And up next, right here, is the opening trade. Guy and Critty will take you to the open. Stay with us. This is Bloomberg.